The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments, surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're talking about money. It's actually me today. Al is preparing on the seminar. So you get just me. I want to take you back. March 17th, 2016 radio program. I posed the question, we're in the middle of a secular bull market, a bull market that's run from 2009 for 7 years. How does it end? I said I quoted Howard Marks saying, you cannot predict, but you can prepare. And I really have to apologize to a lot of listeners. Because I posed it as just a probability, I said, this is what I think. I wasn't very forceful. I wasn't forceful at all. I said, the way you prepare is you have to build a margin of safety. You have to build extra net worth in the event of inflation. Because that's how I said the bull market was probably going to end. I said, purchasing power from 1961 to 1980, the dollar had lost 70% of its purchasing power. In other words, what you could buy for $1 in 1961 would cost you $3 in 1980. And I didn't convince many listeners to seriously consider what was going on. And I apologize for that. I was not very forceful. And I laid it out as this is the highest probability, and maybe you should consider this, and I wasn't very forceful at all. 5 years later, inflation surges to 9%. Had you been prepared, like actually the clients that were with me in 2016, the ones that came in 2017 and 18 and 19, had you been prepared? That drop in our accounts, and we had a dramatic drop in our accounts, still, it was much better than the average financial advisor was doing. It was enough to more than offset all the inflation that took place, and not only the inflation that took place on the consumer price index, some of the informal evaluations of inflation, like looking at medical care, like looking at the price of eggs, for example, it took care of that as well. And yes, I have to say those people that waited until 2020 and 21, they still haven't fully recovered, but I would expect that they will, and I depend upon my track record. And while I have to say past performance is no guarantee of future returns, I do stand on the past performance, and I do look at what people did if they were a client before 2020. People in 2022 and 23 and now in 24 have all exceeded where they were. But I wasn't very forceful. I said, I think this is where we should be. And I learned a lesson from that. I learned a lesson that I should be more forceful. And Al has learned a lesson from that because we are doing a seminar on July 25th. I've talked about it before. I'm going to continue to talk about it. Al Souza, our VP of investments, is going to do the presentation. It's going to be at Tulio's restaurant, downtown Seattle. It's easy to get to. There's going to be valet parking. There's going to be a full dinner. We have a limited number of spaces left. We are getting signups and have been getting signups, but we are limited to 24 places. And we need $25 to hold the reservation. There's no free lunch or free dinner. And I would recommend, even as you listen to me now, you pick up the phone and call 206-903-1019. Or if you're on a computer, you can actually send an email to asouza@adamsfinancialconcepts.com. And let me repeat those in case you didn't pick them up. Carl is at 206-903-1019. And leave a message. Say you're interested in the seminar, leave your name and your phone number, and he will call you back and get it set up. Or you can email asouza, ASOUZA, at Adams Financial Concepts. Do that. We have serious reservations about what's going to be going on in the next 10 to 20 years. And it's something you don't want to put off. I'm sure that your current advisor is not telling you this, and Al spent considerable time, and I fully agree with what he has to say, and I believe you will too. The average financial advisor is is returning 5%. Inflation now is running a little over 4%. So you're just barely treading water. And if inflation ticks up again, you're going to be sinking. You're going to be sinking. We want our clients and our existing clients. I am as sure as I can be, and I depend upon an almost 40-year track record of saying our clients will do well through that whole period of time. They're not going to lose purchasing power. Now is the time to prepare. Now is the time to prepare. Now is the time to sign up for the seminar. There were those, if you look back to 2005 and 2006, look back at the Big Short movie that came out or the book, there were those who saw disaster coming. No, I did not see a disaster. What I talked about in those early days and sent newsletters is a crunch in real estate, but I didn't see the crisis. If you listen to hundreds of advisors today, they say they all saw it coming. Not true. Not true at all. Hardly anyone saw what was going to happen. There were very few, and most of them are outlined in that book. But there are things. That was like a black swan. No one expected it to happen. Economists thought that the 1970s, or for 70 years, that the economy was in a golden period. It was the golden period. There were not going to be bank panics. There were not going to be bank failures. It was all going to be going forward. It was not going to be like the Great Depression where over 4,000 banks failed. It was a time in which people who put their money into CDs were safe. What they didn't figure on was the endowments and the institutions and the hedge funds that had hundreds of millions of dollars and were not protected by the $100,000. But it was a very gradual time. It was gradual and built, but few people saw it coming. 1950s, 1965, inflation was running 1% to 2%, but it was a gradual increase. It didn't suddenly charge up. Look, let me read the numbers. 62, 1%, 63, 1.3, 64, 1.3, 65, 1.6, 66, 2.9, 67, 3.1, 68, 4.2, 69, 5.5, 1970, 5.7. You can see the trend. When you look at it over a 10-year time period, you can see inflation was heating up. It was beginning to grow. It was like that old story of the frog. Take a frog, drop it in boiling water, and it jumps out immediately. Put the frog in cold water and slowly heat it up to boiling, and the frog will sit there all day. I don't know that story is really true. I've heard people say that it's really a fake story, but it illustrates what was going on. Inflation was just creeping up every year, a little more, until suddenly, when you had the oil embargo, inflation surged to double digits. Will that happen again? Maybe. Maybe we're on our way. Don't get caught with that. Think about what we've seen since 2000. Inflation has been really pretty benign, according to most people, except for that period of time, 2021 to 2022, and going forward the last couple of years, inflation was pretty benign. But if you look at it in reality, gas prices from 2000 increased from $1.31 to $3.50. That's almost a triple, up 167%. Propane increased from $1.01 to $2.70. Again, almost a triple. Annual medical cost increased from $5,844 to $16,192. Again, almost a triple. Pet services, taking care of your pets, that's up 190%, almost a triple again. Homeowners' annual insurance has gone from $508 to $1,489. Medicare Part B monthly premium from $45 to $164. That's 3.5-fold. Dental services from $286 to $1,073. That's almost 4 times. Heating oil from $1.15 to $4.34. That's almost 4 times. Out-of-pocket prescription drug cost from $1,102 to $4,500. That's almost a 500% increase, 4.5 times. Eggs, you know what's gone on with eggs. 98 cents a dozen to $4.21, and some even more expensive. I've seen eggs priced at $8 a dozen. That's when consumer prices were pretty benign during most of that period of time. Consumer price index was only up 2.5% annually if you look at the period of time from 2000 to 2023. But the prices I gave you, they were up 300%, 200%, 400%. Social Security at the same time was up 62%. So if you were getting $1,000 in Social Security, you're getting $1,620 in Social Security. Nowhere near what was needed. So, listening to the gurus, they'll tell you that the Fed is ready to start lowering rates. The world is coming to a better time, and I hope that's really true. I hope it's true for everybody. But I go back to Howard Marks. It's a time to be prepared. You can't predict, but you can prepare. And we have a seminar that will help you prepare. The solution, we think, is fairly simple. It's not a cookie cutter kind of approach, but we think the solution is pretty simple. We want you to join us at Tulio's on July 25th. And I'll get more of that after we come back from commercial break. Don't go away. There's so much more to say. Do join us for the seminar.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Okay, welcome back. I started to mention the seminar once again. We are having a seminar on July 25th. I'll get to more details later on. But things that have never happened before happen all the time. Think about the dot-com bust. Of course, we'd seen bubbles before, but it was like a black elephant. People in 98 and 99 could see there was too much froth and there was no earnings. There were no profits being generated by all these companies, and yet the prices were soaring. A few. I got out of it before 98, but I could see what was happening in 2000, 2001 were very, very good for my clients. Not good for 98 and 99, but we more than made up for it in 2000, 2001. Think about the Great Recession. The economists called it the golden period. For 70 years, there'd never been anything close to the Great Depression like we'd seen before. They expected never again would we have a Great Depression or a Great Recession. We'd seen a lot of those prior to 2000 or 1913 before establishing the Federal Reserve. Almost every other year was a recession or a depression. And since the 30s, nothing. They were so happy. They thought it was the golden period until we suddenly had a Great Recession. A black swan, no one expected it, and it slammed the markets. Who in 2019 would have said a disease was going to happen the following year that would kill over 7 million people worldwide, and over 1 million Americans would die from that disease? A little tiny thing, a little tiny black swan, a little tiny virus. And it slammed the markets for a while. The world central banks poured a ton of money in, a ton of money. I had done a program a year before that, in which I said, who knows what the next black swan will be, but there will be one. And I talked about inflation. I have talked about inflation since 2016, and I'm continuing to talk about it because it's not a black swan. It's a black elephant. People can see it, and they see it happening, and they see maybe things are going away, and maybe they're not. Are we done? We don't think so. We see 6 major issues on the horizon, black swans and black elephants, which are going to impact your investments. When we look at government spending, the U.S. government's spending a ton of money. They're spending more than they're taking in. That just adds to a debt. But it's not just our government that's spending money and has spent money. The world is awash in debt. The world has $307 trillion worth of debt. 80% of that's in developed countries, but $307 trillion, the worldwide GDP is just $100 trillion. So that the debt is 3 times GDP. And there's a relationship between those two. Think about it in terms of yourself. If you want a mortgage on a house, you can go out and borrow. If you make $100,000 a year, you can borrow up to, say, $300,000. But if you make $500,000, you can borrow $1.5 million. So there's a relationship between your income and the amount of debt you can have. The same is true of countries. The difference between countries is there's no finite time. Countries generally don't die. People die and their debts have to be paid off. Countries continue to run debts for centuries. England and France, Greece, Germany, the United States, all running debts for a long time. But right now, the situation is there's more debt than GDP. 6 of the 7 G7 nations have debt that's over 100% of GDP. Japan is 255%. Italy, 144. Number 3 on the list is the United States at 123. France, 110. Canada, 106. The UK, 104. There are 54 nations in this world on the verge of a financial crisis. 54 nations. 22 nations are either on the verge of default or have already defaulted. It's one of the black elephants. Everyone can see it, but nobody does much about it. And it may work itself out. But there's only 4 ways in which you get out of a debt crisis, excessive debt. One is to grow your economy. Back to my example of the person who has an income in a house. If you want a bigger mortgage, and if your mortgage is an arm and growing, if you increase your income, you can afford more debt. If nations can grow out of it, if they can grow their GDP, they may be able to pay down some of that debt. They may be able to reduce spending. The second way, reduce spending. And you reduce spending on the social net, on education, on infrastructure. You cut down on pensions. You cut back on Social Security. You cut back on health care. You cut back on subsidies for agriculture, subsidies for the unemployed, all the medical expenses. You cut back on all of those. That's one way to do it. When you look at England in the early 1700s, that's what they chose to do, is to do an austerity program where they cut their social net, cut all their government spending, and they had decades of times like 2008. It was a very, very difficult time. The third way is simply to default. Don't pay the interest and reduce or delete your interest payments. And that's where we see 54 nations on the verge of that. 22 nations are probably going to default. Think about that. That's a big way out of it. And so many of those nations built up that debt around COVID because they were supporting their people. They were paying them income. They were supporting their unemployment. They were paying businesses. All of that comes back in debt. And there has to be a payment of interest and principal. Or you delete interest or cut back the interest, you cut back the principal. And 22 nations are on the verge of doing that. And the fourth way is you just simply print money. We experienced that in 2020 and 21. The Fed simply bought bonds, and they have a checkbook. They just wrote a checkbook and bought bonds, they bought stocks, they bought whatever assets were out there, pumping money into the economy. And during a crisis, that helped. The Fed wasn't the only central bank doing that. All across Europe, China, and many of those nations, those 54 nations, in fact, were printing money from their central bank, putting it into the system, and that got us out of 2020, but it put us into this crisis. The impact of that in this country was we saw inflation tick up to 9%. In Turkey, it ticked up to almost 100%, I believe. We see it around the world where inflation is going wild in Argentina. And if you remember some of the places where it's happened. We believe that there's a solution, and the solution is not that difficult. But that's why we're doing the seminar. July 25th, Al Souza, our Vice President of Investments, is doing the presentation. It's going to be at Tulio's restaurant, downtown Seattle. Easy to get to. I'll be there as well. There's valet parking. There's a full dinner. There's a limited number of places. We just have 24 places, and we're getting close to being sold out. $25 to hold the reservation. It's not a free lunch or a free dinner. And the dinner's worth a lot more than $25, but the $25 holds your reservation. So pick up the phone and call. Don't wait for years to be caught by surprise. Don't put it off. Call right now. Even as the program is going, call Carl at 206-903-1019. Leave a message. You can email asouza, ASOUZA, at Adams Financial Concepts, plural. Let me repeat that. Carl, 206-903-1019. Email asouza, ASOUZA, at adamsfinancialconcepts.com. And I sound like one of those infomercials on TV. We'll throw in the pan and the free shipping. Just joking. This is really important. I can't emphasize enough how important it is. Had people listened to me in 2016 when I said the high probability is we're going to have inflation, and if they would have taken action then, they would have cruised through this whole inflation period of time, through the 20 and 21 period of time when they saw accounts down. They would have cruised through it just fine, and they would have realized their purchasing power was the same or more than they had before. I believe you need to hear this. The average financial advisor is producing about a 5% return, just treading water, just hanging on. If inflation kicks up to levels like it was before of 10% or 12%, that 5% doesn't do much. Not only that, most of those assets will sink in value. You not only have a problem of inflation running away or stagflation running away, you're not only losing purchasing power, but you're losing net worth as well. Do call us. Call Carl, 206-903-1019, or email asouza, ASOUZA, at adamsfinancialconcepts.com. It's been a little over 10 years since we had Greece. And remember, that was one country. It was their fifth default in 150 years. And remember the turmoil that went on in our markets over that. It's been 10 years, just 10 years. Bondholders had already taken a cut of 50% of their principal. There was talk of kicking them out of the EU. There were onerous terms of what they had to do for cutting back pensions and changing retirement age. GDP was just a tiny bit, 1/4% of the world GDP. And think of the impact that had on our markets. Now multiply that by 22 or 54 and see what the impact can be. We want to get you through this period of time. Call Carl. Send an email to Al. Sign up for the seminar. Please, please, please. I'll be right back after this commercial break. So much more.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
I'm back again. Push you to sign up for the seminar. It's really important. I believe that history doesn't repeat, that it rhymes, and there's lessons to be learned from the past. You hear, and I've heard people talk about it, the stock market is a hedge against inflation. Let me tell you, that's a complete falsehood. A complete falsehood. In 1966, the Dow hit a new high of 999 point something. It had rallied, and then it began to drop. It dropped 20% in the fall of 1966 and began to settle down, and then it continued and began to rally, and it took until late 1968 when the Dow again got to 1,000. And the last couple of months of 1968, the market began to fade again, and it continued to fade and fade and fade until mid-1970s when it was down 30%. It was down to 700. It had been 1,000. It was now down to 700. And a new rally began in mid-1970, and that rally took it to the end of 1972 when it again hit 1,000. And people were happy again. And then the market began to roll over, and by mid-74, it was down 40%. 40%. It had gone from 1,000 to 800, back to 1,000, down 30% to 700, back to 1,000. Then it went down 40% to 600. But by early 1975, it had rallied back to over 1,000 again. And then it rolled over until the end of 78. It was back to 780, back down another 20%. So it had hit 1,000 in 1966, rolled down 20%, got back to 1,000, rolled down 30%, got back to 1,000, rolled over 40%, back to 1,000. And in 78, 12 years later, it was down at 780, off 22% from where it had been in 1966, 12 years before. And then something happened. From 1978, it began to rally, and by 1982, it hit a new high of 1,000. It actually surpassed 1,000. When I said it got to 1,000, it never quite got to 1,000 any of those previous times. It always got to 999 or 998. But in 1982, it went above 1,000, and it continued up with bounces in 1987 and 90 to over 10,000. But the whole point of that is, during that period of time, 1966 to 1982, the market wasn't an offset to inflation. Inflation during that period of time continued to surge upward, continued to surge so that the Standard & Poor's stood still while the Consumer Price Index tripled in value. Almost tripled in value. And I can't predict how things are going to happen the same way, but we've seen the lesson. Stocks in general were not a hedge against inflation. Private equity is not a hedge against inflation. Private credit is not a hedge. Oil was a key in the 1970s or early 1970s, but it wasn't in the late 70s. Oil is on a decline. Actually, oil is up, but gasoline's on a decline. And people feel that oil may be reaching a peak. 5 years is a long time. 3 years is a long time. 10 years is an eternity. 18 years, almost unthinkable. But you know what? $100,000 of purchasing power in the stock market in 1961 would have taken 32 years to reach the same purchasing power as the Consumer Price Index. 32 years. 32 years. During those 32 years, the Standard & Poor's would have to grow sixfold to equal the Consumer Price Index. The Consumer Price Index increased sixfold between 1961 and 1993. The Standard & Poor's would have had to grow sixfold, and did grow sixfold during that period of time, but it took 32 years before they were equal. So the idea of putting money into an index fund and being in the stock market in general is not a solution. The solution is pretty simple. Solution is pretty straightforward. It's not alternative investments, by the way. Not at all. You know, I mentioned before the prices of eggs, the prices of pet care, the prices of medical care. The Consumer Price Index increased just an average since 2000 to 2023, in those 23 years, just increased from 100 to 176. COLA increased from 100 to 162. But if you look at the dollar between 1960 and 1980, it lost 70% of its purchasing power. What cost $1 to buy in 60 cost $3 in 1980. 1960, a first-class stamp was 4 cents. First-class stamp, 4 cents. A Coke was 10 cents. Dozen eggs, 57 cents. Gallon of milk was 49 cents. 1960. By 1980, the first-class stamp was 15 cents. Think about where it is today. And they're going to increase it again. A Coke was 35 cents, up from 10 cents in 1960. Dozen eggs were 91 cents, up from 57 cents. And a gallon of milk was $2.16, up from 49 cents. Those portfolios that sat in cash had lost 70%. Those portfolios that sat in bonds had lost 70%. You know, sometimes beliefs are really a myth. There's a belief that more volatility means more risk. And the reality is the answer is yes and no. You know, it's commonly believed more volatility equals more risk. And people especially think about that now as we've gone through the pandemic, as we've gone through the Great Recession, as we went through the dot-com bust. A belief that a T-bill portfolio is safer and more conservative than a stock portfolio. But it really depends upon what type of risk. Credit risk, or the risk of losing everything, or the risk of purchasing power. It all depends upon your time horizon. If your time horizon is 30 days, T-bills are much safer. If it's 6 months, it's much safer. But if your risk is over 3 or 5 or 10 years, if you look at a hypothetical portfolio of 100,000, both over 25 years, 3 bills rolled over and maybe getting 3%. 3%'s been the average. They would be at 222,000. They would have more than doubled in price, which seems pretty good. But if the stock market at 9%, that 100,000 would be 862,000. Where would you be better off? Where's the greater risk? And especially if inflation is 4 or 5 or 9%. Think about it. A T-bill today is only going to keep you even with inflation at current inflation rates. If inflation kicks up more, a T-bill is not going to do it. Robert Markham wrote in the book, Hazardous to Your Wealth, Extraordinary Popular Delusions and the Madness of Mutual Fund Experts. And I take this quote, the book takes a skeptical look at what, until now, has been the commonly accepted way of things in the mutual fund world. You'll see that much of what financial planners, the media, advisors, mutual fund companies have told you is simply not true. It's a bizarre, almost Alice in Wonderland type of story. There are ways to reduce risk that can actually become dangerous, while attempts to achieve large gains can result in losses, not profit. It's a story of expertise and proclaiming the difference of reality. We believe there's a solution, and it's not difficult, but the time to act is now. Come to the seminar. Did I say it again? I'm going to say it again. Thursday, July 25th, 7 to 9 p.m. at Tulio's. Full dinner, valet parking. Space is limited to just 24 people, and we are filling up. It's a first come and first served. $25 non-refundable deposit to hold your reservation. You have to come. We're going to be talking about all of these things and talking about a solution. So call and leave a message. And the solution is not alternative investments. I don't want you to think about that. The alternative is not annuities. Just a little preview. We think private equity, private credit, some of the partnerships are in deep trouble. if we see inflation come. So call Carl, 206-903-101. Let me say it again, 206-903-1019. Now, Carl's out of the office, so he's not going to be able to answer the call, but he will take the message and he will get back to you on Monday. So do call and make sure you leave a message. Give your name and your phone number and say, I want to go to the seminar. You can email Al Souza, A-S-O-U-Z-A, Souza, at Adams Financial Concepts. Let me give you the phone number once more, 206-903-1019. Call and leave a message. Say that you want to go to the seminar. Bring friends. I mean, why not? If you're really concerned about your family, bring family members. It's important to hear what's being said. It's never have I been, and I've been in this business for 40 years, never have I been as concerned as I am right now. 40 years. And I've always been optimistic about what's going on. I told you, during the Great Recession, just hang in there. I told you during the dot-com time, just hang in there. Told you during the pandemic, just hang in there. I was always optimistic. I told you we're having inflation and there's things that you need to do, but I was still optimistic. That optimism is really being clouded right now. I think you need to be at this seminar. Really, really do. Don't go away from today's program and not take any action. Call Carl, 206-903-1009. Be right back after this. Let's talk further.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
I've been really negative through most of this program. I'm really concerned. I'm very, very, very concerned, to tell you. I think you should attend the seminar, and I believe that we have a solution that will work based on 40 years of my experience, on 13 years of Al's experience. We bring a lot of experience to the table, and clients have done well during that period. 20 and 21, a little less so. They'll do well as things come. But I want to finish with something kind of positive. I think it's positive. It may be negative, but Mitch Anthony in 2015 wrote a couple articles for Financial Advisor magazine called Money's White Lie, 4 lies. And I like this. The lies are, number 1, money will make you safe. It's a lie. 2, money will make you secure. It's a lie. 3, money will give you peace of mind. It's a lie. 4, money will make you somebody. It's a lie. You know, it can't make you safe. Promises that it can't deliver. It can't protect you from risk or harm. The more money you have, the more you're a target of scams and cons. Money doesn't keep away the health problems. It can't stop you from cancer or heart disease or the pandemic. The best insurance in the world can't keep your job. Job benefits disappear. Think about Kodak. People thought they had a complete retirement. Company files Chapter 11 or 7. Kodak, the pension goes away. And it didn't completely go away, but it can. The promise of safety is flawed. It can take insurance, but it can't be completely safe. Think of the second lie. Money makes you secure. You know, the fact is, without risk, there's smaller returns. You are subject to those inflation risk and credit risk. You know, your house can burn down. Money won't keep your house from burning down. It won't keep your tenants from leaving your building in a down market. Ask some of the office towers. Their tenants have been leaving right and left. Savings are only insured until $250 if you put it into banks. Stocks are only as good as the stock management, the portfolio management. Everything and everyone is at risk. People are greedy. People jump on financial bandwagons which turn out to be fake. People do stupid things with money. Listen to stories that sound so good again and again. Job security. In 2008, 2009, you know, it was the big bad wolf, the big corporations. They weren't worried about anybody's security. They laid off a lot of their people. It wasn't the low-level people. It was everybody. Corporate promises are true until they're not true. You know, think of the pilots. Now, they had a pension 30 years ago. That's now 1/3. Money doesn't give you peace of mind. Nope. 43% of North Americans take mood-altering prescriptions on a regular basis. 25% of women, maybe a little more. Over 25% of women over 50 are addicted to prescription. Paxil and Zoloft, right, as the 7th and 8th of 10 prescriptions. 40 million American adults suffer from anxiety disorder. 25% of North American adults have major depressive episodes at some time. Peace of mind is spiritual. It's not monetary. Money won't make you somebody either. It can buy you a bed, but it can't put you to sleep. You can buy books, but not brains. You can buy food, but not an appetite. You can buy finery, but not beauty. You can buy a house, but that's not a home. You can buy medicine, but that doesn't ensure your health. You can buy luxuries, but that's not culture. You can buy a lot of amusements, but not happiness. You can buy flattery, but not respect. You know what? I saw a sign in Tbilisi when I was in Tbilisi in the country of Georgia. It was on the wall of a person that had a cognac factory. And it was a long time saying from the person's grandfather that said, money is a terrible boss. Money's a great servant. You know what? People rely on money for peace of mind. People rely on money for their happiness. People rely on money for their safety and security. People rely on money to make themselves somebody. All of those are lies. Money is a great servant. It's not a boss. And you should think about that. You should come to our seminar because money, it's not about making you wealthy. It's about keeping your purchasing power. It's about keeping your quality of life. It's about keeping you from reaching the point where you're sitting at the kitchen table or in a room where you're sitting analyzing what expenses to cut because you don't have enough money to go around. We want you to have the quality of life. We want you to continue a quality of life. And I've never been more serious about this whole thing. There's so many things going on. There's 6 huge things going on that are going to affect you. And I hope that none of the 6 becomes a problem, but there's 6. If any one of the 6 happen, there's an issue. There's a big issue. So we want you to be safe. We want you to maintain your quality of life. We want you to be able to feel comfort and secure. We want you to have peace of mind. We want you to feel that you have and be content with what you have and where you are and not have the worries. So here we are again, July 25th at Tulio, 7 to 9 p.m. It's a full dinner, valet parking, and $25 non-refundable deposit. Call Carl, 206-903-1019. He's not in the office on Saturdays. Call and leave a message and say you want to come to the seminar. He'll call you back, leave your phone number, leave your name. He'll call you back, give you the details. Do that. Or if you want to send Al Souza a message, it's Souza, ASOUZA, at adamsfinancialconcepts.com. Don't miss this. We have only 24 places, and I don't know how many. We are beginning to fill up, so do come. It's a first come, first serve. Do come and hear what our simple approach is. And it really is not a very complicated thing. It's also not a cookie cutter thing. It's not something you're going to hear from your financial advisor. It's not something you're going to hear on CNBC. It's not something you're going to hear on the radio, other places. It's not something you're going to read in the newspaper. We think it's a fairly straightforward and simple solution. It's based on 53 years of experience between the two of us. And we think it's reasonable. We think it's effective. And we think it will give you peace of mind. So come. Don't take the risk of losing on the quality of life. Talk about risk in this financial markets. This is a risk of your net worth, of your income. So come. Carl, 206-903-1019. Make the call now. Make the call now. The program's coming to an end. Make the call now. It's something that will be well worthwhile. It's not alternative investments. It is the way in which we believe you'll experience a quality of life that doesn't change. And until next Saturday, have a very good week. Stay cool. Enjoy the weather. Enjoy the summertime. And we'll be back next Saturday to talk about money. Do have a wonderful weekend and a wonderful week. And until Saturday, about money.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.